We've been giving the bulls, gold bulls, some credit here on the show. You've been one of them for weeks, months, and years for that matter. I guess my first question is, there more to come right now? We've seen gold, a nice surge up through that 2075 area. Everybody was looking at the 2000 level. What are you seeing?
Yeah, it starts to move pretty quick above 2000, Ben. And excuse me, good morning to you too. And we're watching silver as well. Silver is now finally starting to play catch up. And there are some pretty significant underpinnings to this rally that look to continue and get sharper in the months ahead. We're getting some warning signals from the Fed that are pretty constructive and bullish for gold. So I don't want to see anybody get shaken off here or get out and start chasing and that kind of thing. I think this is a pretty long-term significant bull market in the metals and the shares, and people need to kind of buckle in.
I like that, Craig. Chasing is one thing you don't want to necessarily do after a historic move like what we're seeing here up and through that 1800 level. It certainly did build momentum through 2000. This comes on expectations that we'll hear something from lawmakers, as I was talking about at the top of the show. I guess I'm wondering, do we have a situation for a buy, rumor, sell, fact type scenario playing out here that's not uncommon?
Well, yeah, in a sense. And you see that in the mining shares a lot, too. I mean, you get to the earnings reports, and then they kind of ease off for maybe 5 or 6 weeks. So there might be a dip here coming up because they're in the middle of earnings season. But you're right. I mean, we've been expecting on my site something to happen in Washington in July. And that's kind of when things took off because, you got the August recess pending here in Congress. So you think they'd want to get something done in this election year, for God's sake, too, right? So they're going to do something. But what it's doing in the end, Ben, is it's piling on more and more debt, increasing the Fed balance sheet. And there's something really important that people need to understand here. There's a lot of folks that generally don't follow gold, right? I mean, I do, but, we've been wandering in the desert here for years, right? I mean, kind of a forgotten deal. And so if you generally don't follow gold, a lot of folks think, well, it's just the inverse of the dollar. The dollar goes up, gold goes down, and vice versa. But, if that were the case, the last time the dollar index was sub 93 was 2 summers ago in 2018. Well, gold was 1,300. Well, why isn't gold 1,300 now then, right? So there's more to it than that. And the biggest driver, the most significant driver going back for decades, is the level of real inflation-adjusted interest rates. That is what the key driver is for gold. And the reason for that is gold's primary competition, or let me put it this way, maybe a better way to put it is, the primary tier 1 asset for central banks, big institutions, pension funds, and the like is the 10-year treasury, right? That's a foundational asset. Gold is kind of now a competition for it since it was made a tier 1 asset, last year, a couple months ago. Because that's the case, when you start locking in and guaranteeing a negative real return on the 10-year treasury, well, heck, gold that doesn't even, doesn't pay a dividend, sits there and collects dust, suddenly looks like a pretty compelling alternative. And so these levels of negative real rates, and we are at all-time lows in the U.S. for negative real rates on the 10-year treasury, that is what is driving gold. And this rally really took off, Ben, on July the 17th. And something happened that day that a lot of people missed. And I don't want to sit here and hog all the time. So I'll if you want me to tell you what that is, I'll be happy.
Yeah, I want to hear what that is, but I'm curious in terms of the move that we've seen, rates to the downside. We were just looking at the TNX versus gold to the upside, and we've got the 5-year in the new lows recently. I guess I'm wondering, do we expect this to continue? And what I've been asking a lot of our guests, the bulls that have been behind this trade for a long time, as you have been, what could derail this right now? Would it be rates kind of fizzling out to the downside now and just sort of inching the way higher? We've been hearing about how talks of a vaccine could ultimately slow this move to the downside. I mean, we don't think we're going to hear any plans for stimulus measures to slow anytime soon. What could derail this?
Yeah, traditionally, that would be what it is. And I don't want to make it sound like, hey, this is easy. This is a layup. This is going to happen. But the math is the math here. And I think we're headed into a period of stagflation, regardless of how quickly we come up with a vaccine or some effective therapeutics. And so you're looking at a period of the 1970s, which was also a significant period of negative real rates. And how great the gold and the mining shares did in the 70s. That hint that you got on July the 17th, and any trader can pull up a daily chart and see that, wow, this move in gold and silver started on July 17th. We had a trial balloon floated out by Bloomberg that day, about 5 in the morning, that said soon the Fed was going to institute a major policy change where they're going to let inflation move past 2%. And at the same time, because they can't allow interest rates to move up, they're going to institute yield curve control. And that this could come as soon as September. Well, Ben, just yesterday, CNBC put out basically the same article. So now I think we can pretty much say, I mean, these aren't just trial balloons. This is coming. And Powell admitted back in the June FOMC that they received a presentation on yield curve control. And the Fed has done this before. That's what's important. The last time the GDP or debt to GDP ratio got this high in World War II, that's exactly what the Fed did. So if they do this again, okay, you talk about rates going up, and they can't allow rates to go up because it's the servicing of the debt. We saw what happened in 2018 when rates got above 3%. So they'll have to institute yield curve control. So if they let inflation overshoot 2, let's say it goes to 3, and they institute yield curve control where, just for simplicity's sake, they don't let the 10-year Treasury go past 1. Well, now we're talking -2 for real rates. Gold's here at 2070 at just slightly like -1.1, all-time lows. So if the Fed does this, and like I said, everything is indicating that that's exactly what they're going to do. History is their guide here. Man, I like where we began this. You don't get shaken off thinking, well, you know, the dollar maybe is going to bounce from oversold and that's going to be it for gold. I mean, this is one of those deals where you want to buy the dips.
Yeah, this is seems to be the real deal, so to say. Let's talk about how silver's definitely participating and also taking notice. Maybe not to the same extent. It seemed a little bit late to the party, but to 28.28 last I saw.
Hey, you know, and I know you got a lot of traders watching your show. What we've been watching, I mean, you and I even spoke about this the end of last year. The key level for gold was 1550 on a weekly basis because that level had been support in 2011 and 2013. And once it got above there, it pulled back and tested it. Now here we are 30 some odd percent higher. Following that came the GDX, which moved through 32.25. That's a gold mining ETF. That 32.25 was its level from April of 2013. It got through there, and now it's, what, 44, 45. The GDXJ then was third in line to move through its level of 56. And so naturally, I mean, we were sitting on my side going, well, silver's going to play catch up at some point because silver's level was 26. So now here we are. We're above, what are we, 28 something today. Now we got a long way to go. We got the employment report tomorrow, and anything can happen. But a weekly close in COMEX silver above 26 is significantly bullish and opens the door for maybe 30 or 34. And then from there, I mean, I feel really confident at this point with this Fed policy changes are coming. I mean, we're going to keep going higher. And then you can look at the chart and you can kind of pretty much draw lines where you think it might go in the months ahead.
So we've got silver, I actually said 28.28. It's posting new highs as we speak, up to 28.42.5 in the overnight session. It's up 5% right now. Let's talk a little bit about some of the jobs data tomorrow. Copper's lagging a little bit. Gold into these numbers. I guess in some ways it would be healthy. Some traders, bulls, would not mind seeing some sort of consolidation up at these levels. Could the jobs data provide that stopping point or that stopping price for gold to kind of start to just sort of trade sideways and provide some acceptance of these levels right now, because there's still the uncertainty at this point. I mean, we could see a V-top come into play here easily. Many want to see some consolidation. Is that what you would like to see?
Oh, sure. Yeah, you're always going to get ebbs and flows, right? Like anything, you're going to get pullbacks and dips, and that 2 steps forward and 1 step back.
Right.
The key thing for people to look, I tried to find a proxy for these real interest rates on a daily basis. The best thing I have found, and this would be the thing that traders should watch, is the ETF with the symbol TIP, TIP. It's made up of Treasury inflation protected securities. When it is trading higher, real interest rates are going lower. And that thing's been around for about 16 or 17 years, and it's at all-time highs. And it's been moving in a steady up pattern since June the 5th, the jobs report of June the 5th, Friday, July the 5th. It's been moving steadily up, and gold's just been tracking along with it. And sometimes a tip stretches away to the upside, and gold goes sideways and then rushes to catch up. So until you get that tip to consolidate and real interest rates to kind of move slightly back higher and consolidate, gold just keeps going. And just one last thing about the jobs report. I don't even sound Pollyanna here and just say everything's great and never going to be bad again. But we're in this kind of period where, you know, it used to be a good jobs report was bad for gold. But now it's kind of working in both directions. If the jobs report is bad, it just means the Fed's going to have to monetize more debt. And the Treasury said this week they're going to do $2 trillion in new debt the second half of the year. Where's that money going to come from? The Fed. But if the jobs report is good, we're that much closer to kind of stagflation, where the inflationary impact of all this money creation starts to kick in, and that's good for gold because of what that does to real interest rates. And so the last two job report days, even with the surging numbers in June and July, have been really good for gold after maybe an initial dip.
Sure have been.
Let's see if it's not like that again tomorrow, Ben.